Hello everyone, welcome to this episode, and today we'll be talking about income statement. Income statement is one of the three main financial statements. It provides idea about the business performance in terms of sales and cost of sales, and then what was the result in terms of profit or loss. Second one is balance sheet, which is giving us a snapshot about what the business owns and owes at a specific period of time. And third and last one is cash flow statement, which giving us detail about how the company managing its cash. Why we need financial statements? Financial statements are part of accounting system. Accounting system is used to record, sort, analyze, and report the financial data. The most famous generated reports are called financial statements, which provide information about the business financial performance from different angles. All the three are important and correlated with each other. The purpose of those reports is to provide the user about all the required information to make more informed decision, and of course still analysis will be required to be done. Any company want to list its share in official stock market, it should provide regular financial statements. And in this video we'll be focused about one of those reports, which is income statement. Income statement provides summarized information about the business revenue and expense over a period of time. So the very simple format, it will be revenue minus expense, and then we will have a profit or loss. When the revenue is more than the expense, we'll be having profit. And when expense is more than the revenue, we'll be having loss. And since we are looking at profit or loss, this is a statement called the profit and loss statement. Income statement cover period of time, and this period can be either month, a quarter, or a year, which means during this period, income statement will provide the full picture about the business performance and capturing all the revenue and expense related to that specific period in full. This particular nature of income statement is different from the balance sheet one, which provide the information related to a specific point of time. Now let's start breaking income statement into different components. And let's start from revenue. Revenue income generated from business operations. It can be also called top line, sales, or turnover. Revenue can be classified into two main categories. Operatings, which is derived from normal business operations like product sales or service rendered. The second one is non-operating, which is non-recurring revenue derived from secondary source. Example, lawsuit proceeds. Expense, on the other hand, is the cost of the operations the company incur to generate revenue. Expense can be classified into different classification as well. One of the classification is operating and non-operating. Operating expense is ongoing expense for running business. Example, cost of goods sold, cost related to the service rendered, and administration expense. Non-operating expense is not directly related to the business core operations. Example, interest charges. Another classification for the expense is direct and indirect. Direct expense can be directly traced to product produced or service rendered. Example, direct labor charges, direct materials, manufacturing supplies, fuel or power consumption. Indirect expense cannot be directly traced to product or service. Example, administrative expense, selling and distribution cost, office cost, and security cost. Another classification which is related to the behavior of the cost is variable and fixed. Variable cost changes in proportion to the production or sales. They increase as volume increase and decrease as volume decrease. Example, material cost. As we can see from this chart, when sales are increasing, variable cost is increasing. On the other hand, fixed cost, the same amount will be incurred regardless of the business activities and does not change with the increase or decrease of the volume. We can take, for example, the rent, and as we can see from the below chart, although sales is increasing, we are having the same amount of fixed cost. One important component of income statement is the gross profit. This is our first line of profit, which is profit after deducting all costs or expenses related to making and selling product or service from the revenue. Gross profit margin, which is gross profit value divided by revenue into percentage, will tell us how much percentage of revenue left after deducting the cost related to the sales. This is an important matrix as it gives indication about how much the business is efficient in managing its resources. Our second line is indirect operating expenses, which contain, for example, administrative expense and selling and distribution expense. When we deduct indirect operating expense from gross profit, we reach to our operating profit, which is profit of business operation after deducting all operating expense, direct and indirect, including administrative expense from the revenue. Sometimes this profit is called EBIT, which is earning before interest and tax. Then after deducting interest and tax from operating profit, we reach to net profit. Net profit is the residual value of all revenues and gain over all expenses and losses for the period. It's also called the bottom line. Net profit represents the link between income statement and balance sheet as it will be added to the business equity. Accordingly, business value will increase by the profit and decrease by the loss. Net profit margin, which is net profit divided by revenue into percentage, represents the percentage of residual value of each dollar of sales after deducting all the costs and expenses. Of course, higher the ratio is better. However, similar to any other number we want to look at, it's better to compare it with other ratios. Like for example, if we're having higher gross profit margin and lower net profit margin, it might indicate that there is high overhead cost and it's required management attention. Now, after we cover the income statement structure, we'll be looking at example and we'll go through some analysis. This is an example of income statement or a profit and loss statement. Let's go through quick recap for the structure. We're having revenue, then we're having cost of sales. When we deduct cost of sales from revenue, we reach to gross profit. Then we're having administrative expense, selling and distribution expense. When we deduct both expenses from gross profit, we reach to operating income. Then we're having interest expense, income before tax, and then tax. When we deduct tax and interest expense from operating income, we reach to our bottom line, which is net income. This example is having comparative periods of 3 years from 2017 till 2019. Now let's talk about the numbers. Revenue in 2017 we were having 7.1 million, in 2018 7.7 million, and in 2019 8.3 million. Cost of sales we were having 5.9 in 2017, 6.3 in 2018, and 6.9 in 2019. Gross profit in 2017 we were having 1.1 million, in 2018 1.3 million, and in 2019 1.4 million. When you look at the numbers for revenue, cost of sales, and gross profit, which are our three main lines directly contributed to the core operation of the business, we will see that year to year the numbers are growing. Revenue from 7.1 million in 2017 to 8.3 million in 2019, and gross profit 1.1 million in 2017 to 1.4 million in 2019, which is giving us indication that the business is growing. However, for more understanding of the business performance, we can look at more details. For example, we look at the gross profit margin, which is gross profit divided by revenue into percentage. We can see that in 2017 we are having 16%, in 2018 we are having 18%, and in 2019 17%. As we mentioned earlier, gross profit margin will give us how much revenue left after taking out the cost of sales. This is giving us some indication that in 2018 either the selling price got increased or our cost of sales got decreased, and in 2019 was otherwise, either cost of sales got increased or our selling price got decreased. There is one important point need to mention here, that in order to decide about any number, that if it's good or bad, we need to have it versus some kind of benchmark. Like for example, what is our target? What was our historical trend? How is our competitor are doing? And so on. Let's go back to the remaining of the P&L and talk about administrative expense and selling and distribution expense. When we look at those numbers, we can see that there is no much changes in year to year. We are having 220,000 from administrative expense in 2017, and 70,000 in selling and distribution. In 2018, it was 226,000 and 72,000. In 2019, it was 231,000 and 85,000. This is giving us indication that the management of the company are monitoring this cost and not allowing it to increase. Now we reach to operating income, which is the regular income generated from the main operation of the business, and we can see as well that it's growing in year to year. We are having 864,000 in 2017. We are having 1,078,000 in 2018 and 1,094,000 in 2019. Then interest expense, we can see that there's a slight decline in year to year, which means that it could be that we have paid some loan and our interest got declined. So in 2017 we're having 50,000, in 2018 we're having 47,000, and 2019 we're having 45,000. Then we will look at the tax, we can see that in 2017 that it was 162,000, in 2018 was 206,000, and in 2019 was 209,000. Tax, of course, will be following the law of the country. This increase could be because of the increase of the profit. Then net income, which is driven by all the preceding numbers, we can see that in 2017 we are having 651,000, in 2018 we were having 824,000, and in 2019 was 839,000. Final number to look at is net profit margins, which is net profit divided by revenue into percentage. We can see that in 2017 was 9%, got increased by 2% and reached to 11% in 2018, and then we can see that in 2019 went down by 1% and reached to 10%. There is no much difference between gross profit margin and net profit margin, which again emphasizes the idea that management was looking at all the costs below the cost of sales. And by this we covered one example related to income statement. If you like this video, press thumb up and subscribe to the channel so you will not miss similar videos.